Good morning. Happy Friday, everybody. Welcome into this week's long form episode here on Mining Stock Daily. We're covering a lot of things macro, what's going on with, U.S. Chinese tariffs, the market reaction, obviously big rebound in equities, but the bond market is saying something a little bit different, and everybody needs to be paying very close attention to. So Craig Shapiro of the Bear Traps Report joins us once again for a long conversation on these topics, and obviously many more, and then a little bit of projection of where gold plays a part in all of this. Special thank you to Visa Silver, Caliber Mining, and also Integra Resources for their continued support of the podcast. And as always, if you wouldn't mind hitting that like, subscribe, leave any comments within the YouTube channel or on the podcast feed, always much appreciated. All right, here's my conversation with Craig. Have a wonderful weekend. Be well. All right, everybody, welcome into this week's long form episode, and there's a lot to cover because of some interesting moves, and new day, every day is something new here. We're going to welcome back in to the podcast Mr. Craig Shapiro. He is a strategist over at the Bear Traps Report and is becoming a frequent sought-after guest here on Mining Stock Daily. So, Craig, it's good to see you.
How's it going? Good to see you again.
Yeah, head on a swivel every day for every day of 2025. I think you said, it's an interesting start to the year, and I think that goes without saying.
For sure.
Well, here we are, kind of diving away into May. May, they say, sell in May, go away. Summer doldrums are usually a place where, the hedge funds and Wall Street, goes to the ocean and takes the summer off. But here we are. The equity markets have been rising from that bottom, probably noting some exhaustion here. But on the back of that, the bond market is really screaming something at us, and it's not going unnoticed, but it's certainly, I think, a lot of investors and traders are choosing to ignore the signals, I guess, if you could say. Walk us through what you're seeing here this week, and what's got the wind to our sails, but also what's the storm we're heading into.
Yeah, no, it's been a fascinating last 6 months since the election, and we've had this pendulum swing back and forth and back again on what Trump means for markets. What is he trying to accomplish? Is he good for Main Street over Wall Street, or Wall Street over Main Street? And I think we're going through one of those phase transitions again right now. I mean, him being elected led to broad-based, I'd say, market euphoria and real, economic constructiveness about what his policy agenda would mean: tax cuts, deregulation, supply side reform, lower energy costs. People felt, very excited about that outlook exiting 2024 and starting 2025. And I think people believe that, tariffs wouldn't be such a big deal, and, everything would be fine. And then you kind of walk in after the inauguration, and some tough talk on trade starts right away with Mexico and Canada. And we proceed through, back half of February, most of March, and the markets are, kind of chopping to lower. And then we're waiting for this Liberation Day announcement, and boom, Liberation Day comes, and it's way more hawkish than anybody would have expected on the reciprocal tariffs. And so markets are reeling. Folks are concerned. Growth's going to come to an immediate halt. There's a retaliation by China. Supply chain's going to become unraveled. Everybody's fearful. Bond market sells off as foreigners are selling all dollar assets. Stock market selling off. And no one knows what's going to really happen here. And then I guess enough people either called directly into Trump or spoke to Besant or whatever it was, and got them to ratchet back, right? And so we had the kind of first cave, the first 90-day pause on everybody but China. That led to some calming of volatility. Markets find a bottom. Things are okay. Everyone's feeling a little bit better, but the China uncertainty is still out there. 145% tariffs on China. Supply chain is going to be in disarray. Seeing container shipments out of China falling. Everyone's worried about the end of May, early June, empty shelves. Finally, the administration starts to float hey, we're going to talk with China as soon as we can. And then boom, over the weekend, yes, we're going to Switzerland. We're talking to China. Trump then comes out on Friday night or Friday afternoon and says, maybe we'll go down to 80% tariffs. That should probably still be okay. So markets are thinking, okay, tariff rates are going to come down. And over the weekend, Trump completely caves on China. I mean, as far as I'm concerned, I mean, he basically went to an environment where we've removed all the additional reciprocal tariffs that were, and all the the ratcheted up retaliatory tariffs, except for the 10% tariff, which is basically out there on every other country as well. I don't think anybody believed that he would do that because he's been talking about why tariffs are important. Tariff revenues are important. Rebalancing trade is important. Bringing back manufacturing jobs is important. Investing in America is important. And China is the biggest problem here. So what seems to be a very short-term total capitulation, in my view, to kind of go back to where things were prior to April 2nd. For whatever, for a variety of reasons. And so, and not only that, but China is actually, even because they retaliated, China actually has a 10% tariff on the US, where no other country retaliated. No one else has that tariff on us. So it's actually, China is kind of made out, I think, better than most here on, which I think will have other implications for the negotiations. But so markets are broadly euphoric. Volatility has been absolutely crushed. S&P back to 5,900, a 25-ish% move off the lows. But I think you're right. I think the most interesting thing that we're seeing over the course of this week is the bond market's reaction to this has been, I don't think, what people necessarily would have expected, right? I mean, I think the bond market has been selling off really all week. It's been throughout the curve. Now, you could say we've removed rate cuts from the narrative if the worst fears about trade are not going to be realized, right? So if 145% tariffs are not going to be here for very long, and they were here for a month, and they're going away, and they're going back to 10, we've removed that most averse left tail economic outcome from the playbook. And so the idea that the Fed needs to come in and imminently cut rates to address a slowdown in the economy, slowdown in employment, we've taken that off the table. So rate cuts have been removed, which has led to a move higher in yields in the front end of the curve. But interestingly, the back end of the curve has moved as much, and if not even more. I mean, the curve is basically, I mean, it's been bear flattening, between bear flattening, bear steepening really all week, and 10-year yields and 30-year yields have been moving higher again. And so the question is really, what's really going on there? I think it's been a combination of the Fed not going to be accommodating, but also I think the administration has been talking about and trying to transition markets' attention to the budget, and the budget negotiations. And I think this week what we've been hearing is more and more about tax cuts, more and more about a higher SALT deduction, no tax on tips, no tax on Social Security, a variety of other, I'd argue, progressive-like tax policy or populist-like tax policy, and really, no commensurate spending cuts, right? I mean, there had been so much talk through the first couple of months that the administration was going to be, deficit hawkish, right? They were going to reduce the deficit spending. They were going to bring the deficits down. They were going to, bring down inflation by bringing down the deficits. And really, the rhetoric we've been hearing so far has been nothing of that sort. And I think the initial estimates are an additional $3.5 to $4 trillion of deficits out of this budget. So I think the bond market is picking up on that as well. So you have kind of, maybe a better growth outlook, potential for higher deficit spending, and we're in this interesting place where 30-year yields almost are back to 5%. The 10-year yields are 4.5%. We're losing that momentum that the administration has had on lower yields to start the term, and so we're in a weird place here for Trump and for Bessent and for markets.
I kind of feel like maybe the move in the bond market is more representative of the lack of spending cuts. I mean, there'd be more deficit spending. I feel like that's the majority of momentum behind this move. And the one thing you didn't talk about, but really it's been the crushing of the narrative behind Doge, something I have not heard about or had any update, in weeks ever since
Yeah.
the Tesla quarterly call. No, and him announcing he was going to go back to Tesla, and then also obviously it's been obviously they came out with this goal of trying to find $2 trillion of waste to cut, and they
Yeah.
found like 150 million. That's right off the bat, and
Yeah.
that narrative's gone. Like they don't even talk about it anymore.
No, look, I mean, I think the reason I didn't mention it is because I never thought it was going to be a big deal. Because, if you think about the big buckets of spending cuts are defense, are entitlements, interest, veterans affairs benefits, and just things that, are really outside the scope of Doge. And so the things that they were talking about were never really, I didn't think, big enough to move the needle. But you're right. I think there probably was some market pricing or more market acceptance or hope that Doge would actually do a big job here in helping to bring down spending growth momentum for fiscal 25 and again for 26. And it's really not that it's been a failure. It's just the numbers are just not, they're just not that big. And when you have an administration talking about, raising defense spending, and you have interest expense that is not coming down because the Fed's not going to be able to cut rates since inflation is very sticky. No one really wants to touch third rail entitlements. It's just not that difficult. It's not that easy to bring down overall levels of spending. You'd have to cut the non-discretionary, non-defense, the discretionary non-defense spending by like 50, 60, 80% in order to make a dent. It's just you'd be shutting down, big swaths of government. So, but you're right. I think there's maybe that some of that narrative has been removed. But we're in a budget process right now. I think the far right Freedom Caucus members are going to be pushing back probably a bit more aggressively here on some of the, the tax stuff and because this is not really what the administration ran on. It's not what anybody was hopeful for. And, they're looking at having to vote yes on a $4 trillion increase in the debt ceiling. There's a dozen of them that have never, not once, voted for any debt ceiling increase ever since they've been in Congress. And so now they're going to vote for a $4 trillion increase to fund tax cuts with no spending cuts. I don't think we're out of the woods here on this budget, but I agree. I think the bond market, term premiums have been rising. People are thinking the deficits are never going to come down. The Lynn Alden analog about nothing stops this train keeps getting sent around. And I think that's what, I think the bond market's picking that up. And I'd just add foreigners. We could argue about who's been selling, how much they've been selling on the margin. Dollar weakness, foreigners are repatriating capital back to domestic stories in Europe, in Japan, in China. They have been selling US dollar assets. I think that's continuing. And so that's been some more pressure on the bond market. And I think that's why you're seeing higher yields as well.
A spirited conflict and debate between President Trump and the Freedom Caucus is not something I had on my bingo card, Craig. But
one
it seems
big
like
beautiful bill is going to be challenging to get to the table because the most ardent deficit hawks are going to have a problem with it. And these are the types of folks that win their seats by 40, 50 points and can't really be primaried from the further right. So I think there are some of them that, could become an issue here for the administration, in the next few weeks here. But I mean, Trump's done a great job so far, convincing everybody that he knows what he's doing, convincing everyone on his team and on the Republican side to join him, and he got them to, extend reconciliation a few months ago. But here we are. I mean, they have to pass a budget. The X date, I mean, Besson has said is mid-August. Not entirely sure if that's right or wrong. It could be a little bit later than that, probably not sooner. But I think they want to kind of get this done end of July before the Congress goes on recess. That's not that far away. We're only 2.5, 3 months away. A lot of work needs to be done, and I think the Freedom Caucus folks are going to try to get their pound of flesh here.
Yeah. Kind of while we're on this topic, I do want to talk to you about the refinancing options that Secretary Besson does have in front of him. The data point that I have picked up and kind of been using, and please correct me if this is wrong, but I have approximately 30% of U.S. debt needs to be refinanced this year. That's a hefty number at 4.5% on the 2 year, which he has said explicitly use the 10 year as the scorecard for this administration. Well, the scorecard isn't looking pretty at the 10 year at north of 4.5%. But what are the implications here if that 30% of U.S. debt is up for refinancing? And here we are. I mean, we're almost halfway through the year. I mean, we're approaching June here, Craig. What is in front of us that really we need to be keeping very close attention to regarding the refinancing of the national debt with current yields?
Yeah. I mean, we're in this bizarre short-term place here because we are operating under the debt ceiling, which means the government cannot add any new net debt, right? And so I think the trading environment's a little bit bizarre between now and when that gets finished. So right now what's happening is the Treasury is running down the Treasury general account. That's basically the excess cash that the Treasury keeps at the Fed. It's using that to basically pay bills. It's allowed to roll over its existing debt. We're seeing that. So every day that goes by, there's bill auctions, and every week there's bond auctions or note auctions, depending on the time of the month. And so, but we're drawing down on the Treasury general account. When this is finished, when the debt ceiling is lifted and the budget is passed, there will be a significant issuance calendar acceleration in order to restock that Treasury general account. I mean, currently, I think we're in the 500-ish billion. It'll probably get wound down as we spend to close to, 50, $75 billion. And the normal amount of money that's in that account is about 850 billion. So we're going to have a very sizable issuance acceleration, call it, August, September, October, and into the back half of the year. Now, a lot of that is going to be funded with bills, but increasingly, there will be pressure on the Treasury to start terming out some of this debt. And Besson has had two now meetings, the quarterly refinancing meetings, where he said no new duration issuance is going to be needed. I think he's waiting to see, get to the other side of the debt ceiling. My sense is that there are going to be a pickup, an increase in auctions of Treasury securities, maybe as soon as the August refunding. If not that, then certainly by the November. So there will be pressure on Treasury to issue more longer term paper going forward. And it's not like there's going to be failed auctions or a lack of overall demand. Primary dealers always have the ability to take more, and there's been increased talk of regulation to kind of force them to take more. But it's at what price, right? And so,
Yeah.
and as you have
Yeah.
a lack of demand acceleration coming from foreigners because they're sending money home, and we know after this most recent bond sell-off in early April that some hedge funds and others who are playing basis trades and playing swap spread trades are got hurt, and so their leverage is down. It just means that more and higher yields are going to be needed to refinance this debt. And if the Fed cannot find itself in a position to cut rates because inflation is sticky and uncertainty is high, it's just going to be more interest expense, and that makes the deficit worse. And so I think that's the environment we're facing. That's part of the yield story so far. I think that's going to really be with us for much of the rest of the year, unless we get a proper growth slowdown here. And I thought we were on our path to that with all the soft data that was rolling and into the high tariffs. But now that the high tariff regime is kind of off the table, the odds that we're going to have a very protracted slowdown are reduced. And so that desire to own bonds in that environment is less. And so I think we're going to have continued pressure here on yields moving higher. There's not really that much that the administration can do between now and then in order to get it down, but they're going to have to really think hard about how big of a deficit busting budget do they want, over the summer here. That's going to be a big deal.
I want to push back a little bit on this idea of a high tariff environment. Yes, 145% was shockingly high. In fact, it broke everything. Fear index was crazy, just running rampant. And obviously, you saw that in every corner of the markets. And here we are. The Trump administration comes back to the table. We now have this 90-day temporary kind of negotiating window where we are still having 30% tariff. 30, in the back of my mind, like, yes, 30% is not as bad as 145%. That is obvious, but there's still ramifications and consequences. I still think a 30% tariff environment is still pretty damn high, Greg. And it's only been a
Yeah.
couple days. And so, like, we don't know what the effects of 30% tariffs are going to be. Obviously, not as bad as 145%. It doesn't
Right.
shut everything down, but that's still meaningfully high.
Yeah. I mean, so back to this idea of the pendulum. So the pendulum got, let's say, first week of April, 145% tariffs. World's in disarray. Pendulum has moved extremely to one direction where we're going to have a very bad recession. Bonds had actually started to rally first. Rate cuts moved, I think, to over 5 rate cuts were expected. And so people had gotten, like you mentioned, the VIX went up to, north of 50. I mean, so people were very concerned about that environment, and what every day that went by where we had that very high tariff regime, what that was going to mean. Fast forward a month or 5 weeks or so, I think the pendulum has moved, way too far in the other direction, right? Where now I don't think anyone's pricing in any real slowdown. The equities have moved back to 5,900. We've removed most of the rate hikes that had been priced in. Actually, more of the rate hikes than are priced in. So now the market's really only looking for 1.5, 2 cuts. Cuts, 1.5, 2 cuts this year. And so the probability of a recession, markets are pricing in probably a single-digit percentage. And I think that's probably too low, right? Because we have a slowdown that was already developing into 2025. The lower part of the K-shaped economy, consumers had already been crimped from much of the inflation that had been going on prior to Trump being elected. Labor market had been slowing. Inflation was still high. Then you throw the tariffs on. We also more recently, some of the student debt loan forgiveness has gone away. So many folks are now having to pay an increase in student debt loan maturities back to the government. So I think we are headed for a the growth slowdown that I thought we were going to get. I think that now has been priced out. I think now is about to start showing up in the data. We had the soft data had rolled over, but the hard data was holding out because of the pre-buy ahead of tariffs. But I think now big, interesting retail sales print tomorrow for the month of April. Walmart reports, and you have some of the other big box retailers are later this week and early next week. I think we're going to start to see that hard data fall that hasn't come yet. I think it's about to start showing up. And so, but the Fed is not going to be able to react to it, right? So I think we're going to be in this very tough place where the data is rolling over. The Fed can't address it. We're still left with uncertainty because that 90-day period is already now it's only 60 days now for the rest of the world. And so I agree. I think that is that would probably be the bond market bull story, is that we do have the growth slowdown that people were expecting that it was just a month or two delayed. And it's about to come. And if it does, I think equities here at 5,900 are very significantly overpriced. And it wouldn't surprise me if we started to see a correction, between here and the end of the quarter.
I'm curious about a potential lag, especially from retail and consumers here in the U.S. And we know that a lot of stores were kind of front running orders out of China, out of Asia, knowing that knowing tariffs were coming down down the timeline. That has happened since Liberation Day. I mean, shipments out of China heading towards the U.S. have been cut 60%. And so, but as the retailers, as the shelves continue to be stocked with inventories that were purchased and ordered prior to tariffs, we've had more than a month here, Craig. I mean, this pause here is only, as we record, 3 or 4 days old. We're recording Wednesday. We just got the announcement Sunday. So we have more than a month of really depleted shipments out of China of all sorts of goods that have dried up heading to the U.S. That's not something that just picks up overnight in 3.5 days since this has been announced. And there's a lot of like minuscule
Yeah.
kind of, you know, trying to skirt around the tariffs, shipments coming from Vietnam,
Yeah.
Malaysia, that's not, but like, but I don't think Americans have visually seen the repercussions on the shelves yet, but that
Right.
might change this summer.
So the other thing that I think we'll wind up seeing is, my sense is you won't see empty shelves at the big box stores, right? The Walmarts, the Home Depots, the
Mm-hmm.
Lowe's, the largest players in retail, they view this, I suspect, have viewed this largely as another chance to gain share, right? I mean, Amazon's still going to be able to deliver you everything you need as quickly as you want it. There hasn't really been any notable delays in anything that, I don't know, my wife's been ordering every day. So, so I think this is a market share gainer for the biggest companies, but the problem is, small business in this country is getting decimated. And even though we are going to have this reprieve, it's not like small business is being afforded credit lines in order to go out and just go purchase cheaper Chinese goods right now in order to survive for another 3 months, right? Banks are not giving them that additional line of credit here, and small businesses really don't know, right? The outlook is still uncertainty. They see their consumers are still getting crimped. So I think you're going to have this large versus small dichotomy where, maybe some of the biggest companies, you don't really miss a beat, but it's really felt in small business, which often doesn't necessarily show up in the equity market, right? We don't always get that story, but you'll see it in the NFIB small business sentiment. You'll see it in the IWM small cap underperformance, and I think that's where the brunt of this slowdown is going to be felt. You have this higher interest rate environment, which crushes small business and small cap companies. Um, and so I think that's where we'll see those supply chain outages. But if you need to buy something, you just go to Walmart. Maybe you don't see it as much because
Mm-hmm.
Walmart is the master of inventory management and can procure from all over the world. And so sure, there'll be some shelves that of seasonal things that aren't there, but they'll just get filled with other stuff, and maybe they don't miss a beat. But I agree with you. I think certainly for mom and pop retail, this could be the end, right? I think we're going to see more bankruptcies, certainly higher delinquencies have already been coming through across the board. And that's small business is the engine of employment growth. And so that's a real issue. And it's not, in my view, it's not clear the administration, cares as much about small business as it does large business, right? Trump, invites large business CEOs to the White House regularly to announce big CapEx plans, and continues to favor these big mega cap companies with their big dollars. And what's really happening is that small business is just getting crowded out. Now there's a hope that with tax cuts and deregulation, small companies can compete, in the future world. But when they can't get access to goods, you fall behind some of your larger competitors. You never come back.
Yeah. I mean, in a lot of those small businesses, I think in the back of like Amazon, I mean, there's a lot of business via Amazon done with small businesses as well. And it'd be kind of curious to know, how the whole Amazon conglomerate is kind of the forecasting that if those businesses are starting to waver as well. That was just kind of a thought that spurred in the back of my head because we're seeing these networks, like when we talk big conglomerates, it's not just, Amazon providing every little thing. It has provided the network
Right.
for, for transactions to happen. And
Yeah.
so,
No, look, I mean,
yeah.
I think with the elevated tariff, with the extremely elevated tariff regime, we were potentially facing a very sizable slowdown. Um, and now that that's off the table, we're still going to have a slowdown. And it's not clear to me where the bounce impetus is really going to come from. Like, where is the next leg of growth going to come from if we have to now, wait another, I don't know, 4 or 5 months before tax cuts come in? Deregulation is something that's always kind of thrown up there as, this panacea, but what walk me, it's hard to find like the tangible deregulation things that are going to really convince businesses to increase capex, increase hiring when they're being strained for a variety of other different reasons. So yeah, I think we're facing a nominal GDP hit in the back half of 2025 and into 2026, which is going to pressure top line momentum, with the still elevated inflation environment and still broadly a tight labor market, that's going to hit margins, and that's going to hit corporate profits. So for me, um, after this S&P bounce and this just broad risk on bounce, I even mentioned it early in the week. I've started to put equity puts back on here as hedges. I mean, volatility is coming enough, over the course of the last couple of weeks, and I think we're pricing in, very low odds of a slowdown when, to my view, the data since the beginning of the year has been worse than expected, right? Tariff, like as you mentioned, the overall tariff regime is higher than people would have thought. The student loan forgiveness going away is not something that was on the table. So I think the consumer is in worse shape. I think that maybe some of the only offset I'd say is probably lower oil prices, but over the course of the last week or so, oil prices have found a little bit of a bottom, and I suspect that once Trump leaves the Middle East, oil prices are going to go back up again. Consumer may lose that benefit too.
This whole trip to the Middle East is it's interesting. This administration has run on trying to crush globalization. However, it seems like it's open to it here with Middle Eastern money. It's and that's a dangerous problem. I mean, you get into the weeds when it comes to geopolitics and really support for some of terrorist organizations when you're working with almost any country in the Middle East. I mean, I just the headlines maybe look good for the administration, but is this really what we want?
Yeah, I mean, it's a great question. I think stepping back, I think Trump does fancy himself as a pacifist. I think he is trying to lower the heat across all geopolitical hot zones, wherever it may be. Now, is he just selfishly trying to win a Nobel Prize? Possibly. But, I think he wants to see an end to the war in Ukraine and with Russia. I think he did try to intervene between India and Pakistan to dial down some of the temperatures there. The Israel, Middle East, Gaza, Iran situation. I don't think that Trump himself wants to see us dragged into war. And I think, he went to the Middle East, trying to get Saudi, Qatar, UAE to just back him and back America and back them spending money in America, right? And historically, these countries have spent money on buying treasuries, buying U.S. securities, buying U.S. equities. And what that's done is that's led to a structurally overvalued U.S. dollar. That's made it hard for the U.S. to retain competitiveness and to rebuild manufacturing. And so I think he's trying to convince them to, broadly stop doing that, or at least transition from doing that to actually, investing domestically in the United States, in plants, in equipment, in infrastructure, things that can help, bring those jobs back to America without that strong dollar making it more difficult for us to be competitive. But yeah, you're right. I mean, we're getting into bed with some characters that historically maybe we wouldn't have. But I think Trump's trying to again dial down the temperature. But and then at the same vein, we're raising the defense budget by 15%, and it's not clear to me why we need to be doing that. And then we're going to potentially cut Medicare and Medicaid to fund tax cuts. Why can't we just cut defense? So there's a lot of inconsistencies there, I think, with what they're doing. But the scorecard for Trump is clearly big dollars invested domestically in America, right? He keeps touting it was $2 trillion, then it was $4 trillion, then it was $6 trillion, then it was $8 trillion. Now it's above $10 trillion of investments in America. And I think that's a scorecard he's just going to continue to kind of keep ringing the register on, whether or not the numbers are real or not, over the coming weeks, months, and quarters. But the other scorecards, as we mentioned, is lower yields, right? And the 10-year, it needs to show momentum to the downside here in order to prevent a runaway of interest costs on the budget. And Besson has said if the administration can deliver non-inflationary real growth, interest rates will fall. Well, so far they have not been able to deliver that, and interest rates are rising. So there's a disconnect here. The tariff policy also is pissing off foreigners, and they want to move their capital out of America. So that's again pressuring yields higher. So we're in a weird spot here.
Hmm.
And the 10-year at 4.52 or whatever it is right now. I mean, we're 25 basis points off the highs right before Trump came into power early in January. And if we start moving back in that direction again, um, I don't think risk asset markets are going to like it very much.
I was listening to a great conversation with three individuals I have the utmost respect for. Dimitri Kafinas and Grant Williams are doing this podcast series, and one of the last interviews they did was with Russell Napier, and they had and Russell was talking about this repatriation of capital back to the homeland. And what was interesting in the conversation was that Russell made clear, like, this is not something that unwinds in a month. This is something that takes place over a decade, if not longer. You know, foreign, sovereign wealth funds such as the Norway don't just unwind their U.S. holdings
Right.
in a matter of weeks. This is something that structurally happens year after year, and would just he posed the question, or kind of the idea, like, is the rest of the investors in U.S. assets aware to have the longevity to see this through over the next 10 to 15 years? And this
Yeah.
happens on the back of that structural bear market we have in bonds. I mean, here we are today at 4.5%, Craig. In maybe 5 years' time, you and I are still chatting, be like, can you remember when the 10-year was at 4.5%? That was wild. When we might be at 8, 9%.
Yep. Yeah.
It's just something to, like, really kind of consider here. I mean,
Yeah.
how do you have that long-term projection with this repatriation?
Well, look, I mean, I think, the at least for equities, let's say the US equity market cap as a percentage of total market cap, I think maybe got as high as has gotten as high as 70%, and certainly
Yeah.
above 60, so 65, 70%. US GDP is low 20% total GDP. So, the amount of money that's in US assets, versus the contribution of earnings and growth is just way over its skis. And foreign owners or foreign managers of capital have been forced into buying the US exceptionalism story for decades, and accelerated over the course of the last few years on an unhedged basis, because of AI and because of Nvidia and because of the build out around AI in the US. Names are really the only, obviously there's a couple of names here and there globally, but as far as the thematic is concerned, the NASDAQ has kind of been the place to find that super growth in a world of broadly mediocre growth. And so, the way that sovereign wealth funds and big managers abroad work is just slow, methodical, and it's going to, to your point, I mean, to Russell's point, it's going to take quarters, years to start seeing those types of reductions in that exposure to America. I think what we've started to see right now is at the beginning is the hedging, right?
Mm.
That's why the dollar's been weak. It's many of this money has come here unhedged, and because of what Trump has done on tariffs, but and some of the talk about possibly taxing foreign capital, ownership of assets, I think we've started to see many foreign investors say, yeah, I think we should hedge, right? At least we should hedge the currency here. If we're not going to move our capital out, let's at least get currency hedge. Because what we saw is these, very big losses the first 2 weeks of April, as you had, equities down 10 and the currency down another 5 to 10. If you were a foreign manager holding US stocks, you're down 20%, pretty quickly. And so I think we've started to see at least hedging of those securities. But this is going to be, the sovereign wealth funds and managers, they take time. They have quarterly meetings where they move allocations by 5%, right? And these are, Norway has $1 trillion sovereign wealth pool. So we're talking about taking a very long time to, let's say, move from 65% to 50 or to 40%. So I think that pressure is going to be with us for a while, that dollar pressure. And look, it creates a bizarre dynamic for the U.S. government, because the U.S. government has been funded, its largesse has been funded by overseas buyers of treasuries forever. and increasingly they're not showing up, and in fact they have another place to go now in order to store their excess balances, right? They could either invest domestically in their local stories, right? Europe is investing in infrastructure and defense. China wants to, transition more to doing consumption. Japan in infrastructure and defense. So there's domestic narratives now, but there's also gold, right? There's
Yeah.
also moving, storing wealth out of treasuries and into gold as gold becomes a bigger piece of that neutral reserve asset pool. After the rally we've had, over the course of the last 12 to 18 months, gold's a $20+ trillion asset, and I suspect it's going to continue to grow and gain share away from treasury. So eventually the bond market is going to, try to instill discipline on DC. And DC may say, screw you, we're not going to do it, in which case the Fed's going to come in and buy all the bonds.
Right.
But we're not at that point yet, right? We're still at the point where the Fed's actually doing QT. The Fed is not cutting rates. So we will ultimately, I think, get to a place again where the Fed is financing the government's debts. But we have to go through the fire first, and I suspect that's going to be with higher yields first, pressure, forcing politicians to, into challenging decisions about how big of these tax cuts do you want to do? Are you sure you don't want to cut anything on spending? Where do we go from here? So
Yeah. I think the long-term trajectory is a lot higher than where we're at. I know we're at correction. Gold's sitting just about its 50-day moving average here, just a couple dollars south of $3,200 an ounce. I mean, still, after the performance of the last couple months, like, we're bound to get a correction. But I do think things with higher yields, with a lot of this debt, need to be refinanced. And on top of that, less than a year, Jerome Powell's going to take a step back. Trump's going to be putting his own guy in there. I think 2026, you're going to see a lot more spending by the Federal Reserve and like you said, funding the government debt program. I think 2026 is going to be a really volatile year when it comes to the Fed balance sheet. That's the way.
yeah, you'd have to assume Trump is going to put in somebody that is more amenable to the type of regime he wants to run here with lower rates. And frankly, I don't know if Kevin Warsh is the guy on that. I mean, because he's been at least publicly more hawkish on certainly on the Fed's balance sheet. So Waller seems to be more dovish. We'll see ultimately what happens, but I would agree. I think whoever's in that seat is going to be more dovish than the current chair. And if we're in an environment where the central bank is lowering rates in an inflationary environment that hasn't returned to 2%, term premiums are going to rise. Investors are going to demand to be compensated more aggressively for taking that inflation risk, and yields are going to be higher. And if DC wants to run 6, 7, 8% deficits of GDP, the long end of the bond market is going to revolt again around that, and it's going to be also crowded out by the fact that Germany is doing defense spending, and Japan needs to do deficit spending, and if China needs to do deficit spending, so the rest of the world is going to see a higher yield regime too, competing for capital with the U.S. Treasuries that no longer act as the only safe neutral reserve asset in the world. That could be a tough place for the U.S. And yes, the dollar will remain the reserve currency of the world, and we'll continue to trade more in dollars than not. But if we're not storing excess wealth in treasuries as much anymore, and demand for treasuries is falling, that's going to put upward pressure on yields. And we could have a mini balance of payments issue in America. I think some of the trading we've seen so far this year would reflect that already, with the dollar weak and yields up and foreigners repatriating capital.
All right. Craig, let's wrap it up at that. Appreciate your time. Like I said, you're becoming a frequent guest here on MSD. A lot of people love hearing what you have to say. If you're not following Craig on Twitter, please do that. It's a must, at CES921, and also his analyst writing at thebeartrapsreport.com. Thanks so much, Craig. Have a wonderful rest of your spring. We'll catch up with you again here in the coming weeks.
Thanks, Trevor. Appreciate it.